Hello, my name is Scott Hamilton. I'm a certified financial planner, run a business here in Austin, Texas. We help families put together retirement plans and do investing for them. We've done 250 financial plans over the years, and I'd love to work with you and help you achieve your goals. So let's talk about investing today and how we categorize different companies. So we got many different ways of, first off, there's thousands of companies and they're braced all over the world. So trying to get a grasp on that, just how to talk about it. Well, we can categorize them by size. You can have the large cap, small cap, mid cap. Large cap would be like an Exxon. Small cap would be like a Bluebird, which is the bus company that manufactures all the yellow school buses. Or maybe a mid cap, say that would be an Amgen. So that's one way of, and that's by all the outstanding shares times the share price equals a value, and then sort those, and you have large, medium, and small cap. So that's how you that's one way. The other way you can do it is by value or growth. Growth companies tend to be they produce revenue and they generate that revenue and they put it back into the company. You can think of like a Microsoft. It would be a classical example, especially in the older days when they're a younger company. High growth rates, reinvest in the capital back into the firm. And you can think of a value company, as I mentioned earlier, Exxon. They pay high dividends, they're more lower growth rate, more consistent earnings. So you can have value versus growth, large cap versus small cap. Another way to categorize companies is are they domestic or foreign, right? So one way to look at that would be if they're developed countries. So developed would be like US, Canada, Germany, France, Italy, Japan, Australia, New Zealand, etc. These companies tend to have more sophisticated accounting systems, more developed infrastructure, more built out. It's more of a mature country, if you will. And versus an emerging market, it would be Vietnam, Africa, Egypt. And which one should you invest in? Well, they're different. They have various different returns. But if you look at this chart here, it's produced by Dimensional, and they do this every year. I refer to it as an eye chart. Notice that it's got the years along the top, and then the various different countries, and each country is color coded. So when you look at the chart, if you can find the US, it's in here, and notice that it's never number one, it's never really the bottom, it's usually in the middle somewhere. And it's just so random. So it's a great reminder that picking an individual country or a company in a country is a very risky proposition. So it gets back to my overarching financial thesis is you should have a financial plan. You should be broadly diversified, global, and low cost in general. And if you try to pick an individual company, it might be a wonderful company, but it could be in a country that's going to be performing on the worst this year, maybe the best next year. Who knows? You can't predict consistently, reliably for year to year. So therefore, it gets back to the overarching thesis, broadly diversified, low cost, and with a slight global tilt. All right, so that's the difference between emerging markets and developing markets. If you have any questions, I'd love to work with you, help you build a financial plan, help you with your investments. Reach out to us, schedule us to get acquainted meeting. I look forward to chatting. Thank you for your time. Appreciate it.